Today, we're distilling the absolute rock-solid pillars of investing. We're going to draw on the wisdom of legendary experts like neurologist turned financial theorist William Bernstein, along with the foundational principles of Vanguard to give you a clear, actionable roadmap to building long-term wealth. Our main goal here? To cut right through all that Wall Street noise and look at what the evidence actually tells us.
Now, you might have heard a version of this classic thought experiment before, but I want you to really think about the math with me for a second. Would you rather receive $10,000 a day, every single day for a month? Or would you prefer a single penny that doubles every day for that exact same month? The sheer scale of the outcome here is just fascinating. If you took the $10,000 a day, you'd have a very respectable $310,000. But if you chose the doubling penny, you'd end up with over $10.7 million by the end of the month. It's absolutely wild, and it beautifully illustrates the mathematical magic of compound interest. It's not just your money growing, it's your growth growing. And this brilliantly illustrates exactly why you need to start investing immediately. You've really got to treat your money like a seed. Over time, as you earn interest on your interest, that growth just accelerates. You know that old saying, the best time to plant a tree was 20 years ago, but the second best time is right now? Well, it's totally true for investing. It doesn't matter how much you start with, only that you give it time to actually take root.
Let's look at a real-world case study to really cement this idea. Take Megan. She started saving at age 19, put away $2,000 a year for just 8 years, and then stopped entirely at age 26. Her total out-of-pocket investment was just $16,000. Then we have Sarah. She started at 26, literally right when Megan stopped, and she saved that exact same $2,000 diligently for 39 years, putting in a total of $78,000.
So, assuming a 10% return for both of them, Megan ends up with over $1 million at age 65, while Sarah ends up with $883,000. Astonishingly, even though Sarah contributed $62,000 more over her lifetime, Megan won. Why? Simply because she gave compounding a 7-year head start. Time is the absolute heavy lifter in wealth creation. With that in mind, let's run through our agenda. We'll be navigating William Bernstein's 4 pillars of investing and Vanguard's core principles. Pillar 1 is investment theory. Pillar 2 is market history. Pillar 3 is investor psychology. Pillar 4 is the business. And finally, building your winning portfolio.
All right, let's kick things off with Pillar 1, investment theory.
When looking at the theory, to strike the right balance of risk, we fundamentally have to separate 2 concepts. First is your risk tolerance. This is purely psychological, right? It's how emotionally comfortable you are watching your portfolio drop during a market crash without totally panicking. Second is your risk capacity. This is your actual mathematical, financial ability to endure those losses without, say, missing a mortgage payment or delaying retirement. You have to align both of these if you want to survive. Looking at Vanguard's historical numbers side by side, we can see exactly why we take on that risk. Over a short 1-year horizon, cash is incredibly stable, while stocks just whip wildly up and down. But over a 20-year horizon, stocks significantly outperform cash, often by incredibly wide margins. Basically, you accept that short-term roller coaster ride to capture the long-term premium.
As William Bernstein so wisely notes, your primary goal isn't necessarily getting rich quick. It's actually much more defensive than that. The essence of investing is maximizing the odds of success, which really means minimizing the odds of getting poor and running out of money before you die. You don't need to find the next Amazon. You just need to safely fund your future.
Moving right along to Pillar 2, market history. History teaches us that financial markets basically suffer from bipolar disorder. They swing wildly from extreme euphoria, like the dot-com tech bubble of the 1990s, where companies with literally zero earnings commanded massive valuations, to deep, terrifying depressions where perfectly good companies are sold for absolute pennies. Knowing that this is just a historical pattern really helps you stay the course rather than panicking when things go south. Bernstein reminds us here that true financial opportunity almost always arises when the market looks the most terrifying. When the sky is blackest, assets are cheap. If you have the historical context to know that the market eventually recovers, you can view a crash as a massive fire sale rather than the end of the world. And that perfectly tees up Pillar 3, investor psychology. It's often said the biggest threat to your portfolio isn't the Federal Reserve or inflation. It's usually the person staring back at you in the mirror. To understand why, let's look at this fascinating academic rivalry. In one corner, we have Eugene Fama representing Team Efficient Markets. He argues that market prices instantly reflect all available info, meaning you can't beat the market without taking on more risk. In the other corner, Richard Thaler represents Team Behavioral Finance. He argues that human emotional biases, like, overreacting to bad news, create market inefficiencies that smart investors can actually exploit.
Remarkably, despite their totally opposing theories, both of these academic camps manage incredibly successful real-world funds. And they both do it by tilting their portfolios towards small, cheap companies. It's brilliant, because it proves that whether you believe the market is perfectly efficient or driven by behavioral bias, sticking to a disciplined, evidence-based strategy simply works.
Ultimately, no matter which academic side you agree with, your own emotional discipline is the deciding factor. As Bernstein bluntly puts it, your emotions are your financial enemy. Buying high out of greed and selling low out of sheer panic will destroy even the best-laid financial plans. Discipline beats intellect every single time in investing.
Now we reach Pillar 4, the business.
Bernstein treats Wall Street like a battlefield, and honestly, for good reason. He bluntly states that you shouldn't trust brokers who aren't fiduciaries, meaning they aren't legally required to put your interests first. But more importantly, you absolutely must fiercely minimize your investment costs. Past performance is a terrible predictor of future success, but high fees, they'll guarantee you lose money over time. Every dollar you pay in fees is a dollar that isn't compounding in your own account.
All right, let's bring it all together for our conclusion: building your winning portfolio. So we have the theory, the history, the psychology, and the business reality. Now, how do we actually execute? Well, Vanguard offers a fantastic, straightforward checklist for maintaining the discipline required to win. First, make regular, increasing contributions. Second, stay invested when the market drops. Seriously, don't flee to cash. Third, rebalance periodically to make sure your risk tolerance still matches your portfolio. And finally, have a smart, disciplined spending plan when you actually reach retirement.
When you filter all of this incredible information down, the ultimate consensus from both Vanguard and experts like Bernstein is wonderfully simple. Boring, quote-unquote fuddy-duddy, broadly diversified, low-cost index funds are the smartest, safest, and most effective way for the average person to build serious wealth. You really don't need a fancy hedge fund, you just need to own a tiny slice of the entire global market and let it grow.
So, having explored the incredible power of compounding and these 4 foundational pillars of investing, I want to leave you with a provocative thought to reflect on today. Are you relying on a disciplined, strategic, low-cost plan for your future? Or are you letting your emotions, the noise of the media, and those expensive Wall Street fees dictate your financial destiny? The choice and the compounding results are entirely in your hands.